Hello, and thank you for joining us. The latest recording of Performance in Perspective. My name is Izak. I'm joined today by colleagues Michael and Ameer. We're going to be reflecting on markets in 2022, but also the really great start to the year that we've had in 2023. And I think along the way also think about some of the key investment lessons that we can learn from the last year or so. So Michael, we'll start with you. Tough year for global equities last year. Maybe you can just summarize what happened.
Yeah, so 2022 was a year to forget for for global equities, and I think it was pretty much from day one. I think the global markets peaked on the first day of the year, and it was all kind of downhill from there. And that was in response to a few things. And obviously, 2022, lots of things came out of nowhere that people weren't anticipating. But I think generally what affected markets, rising inflation, and the knock-on effect of rising interest rates that I think affected global market pricing. I think in addition, global markets started the year from a valuation perspective at fairly lofty valuations, so you didn't quite have the same margin of safety. And what we saw was, I think, declines across the board in global markets. So the MSCI All Countries World Index, or the ACWI as we call it, that finished the year down by 18% in US dollars. It was worse at one point, so down 25%. It had a bit of a rebound towards the back end of the year, but firmly in what was bear market territory. And I think the other things that affected global markets, there was a very strong US dollar again in 2022, which diluted some of the returns from some of the other global markets. From a style perspective, it was a bad year to be a growth investor. A lot of the growth stocks trading at those lofty valuations that I mentioned, growth was down 28%, whereas value, in contrast, was also down, but only down by around 7%. And then lastly, for emerging markets, it was, I think, with the strong dollar and with China implementing a very stringent zero COVID policy, that affected the returns you got out of emerging markets. As a whole, down 29%. The MSCI China index down 40%. We have subsequently seen a bit of a rebound towards the back end of last year, but still quite a negative year for global markets as a whole.
And a lot of those factors have now turned around, and we're seeing a very strong start to the year, 2023.
Yeah, so 2023, markets have got off on the front foot, and a lot of positivity around global markets, but also a lot of the economic news. So you've seen inflation has peaked and is on the decline, and that potentially opens the door for the interest rate hiking cycle to stop or pause or pivot, whichever terminology you prefer. You've seen the China reopening theme playing out, so with China very quickly reversing the zero COVID policy, and we've seen in other economies that, when you come out of COVID and things reopen, the pickup in economic activity that can lead to. And in addition, we've seen falling commodity prices, particularly in the energy space, and the energy crisis that we had has waned to a certain extent or eased. And global markets up 7% in January alone. It means still on a rolling 12-month basis for the year, you're negative in US dollar terms. In rand terms, you'd be positive because the rand has weakened. But again, I think one of the lessons that you take away from it is just how quickly markets can turn around and the importance of remaining invested.
So Ameer, it was a pretty horrible year for global bonds as well, and so you didn't get that cushioning from global bonds when equities fell. So maybe you could just summarize what happened on global bond markets and how did we respond to that?
Yeah, that's correct, Izak. And I think similar to what Michael had alluded to, the fear of higher interest rates and high inflation certainly had an impact on global bond yields. If you recall, at some point we had a lot of sovereign bonds trading at negative yields, and those are now trading in positive territory. I think Germany and Japan come to mind. But if you look at, let's speak more specifically about the US. We saw US bonds, the 10-year bond, move from 1.6%, I think it was at the beginning of January 2022, and towards the late last year, it moved to about 3.5%. And the US 2-year bond moved from 70 basis points to about 4.5%. So Izak, if you look at the Bloomberg Global Bond Index, it gave you minus 16% in dollars, not too dissimilar from the minus 18% that Michael has spoken about in equity markets. So we didn't get the safety that we would usually get from the bond market. But Izak, with this movement in bond yields, I don't think we should be surprised by the deep negative details we see in the global bond market. But going back to the US, I think another interesting observation that we currently see, and this started around, I think this before the second half of the year. Your US 2-year rate is about 4 point. I'm just going to use, for simplicity, round off numbers. It's about 4.3%, and the US 10-year about 3.5%. So what we have is a bit of an inversion of the yield curve, which actually portends a potential recession. And the thing is, we as investment managers, how do we respond to this type of environment? So what we did capitalize on was was an opportunity in the US high yield market. Now, I just want to unpack this a bit. If you look at US high yields, firstly, the concerns we had is firstly, rising bond yields are not good for investors because you experience a capital loss. And secondly, about the recessionary environment that we still speak of. So how do we actually immunize ourselves against these two aspects? So what we did find is that with US high yield giving you been close to 9%, at one point was in fact a bit higher than 9%, we believe there was sufficient margin of safety in that spread, in the high yield spread, because investors demand compensation for being in high yield bonds. At the same time, it has a risk-free rate component, which is effectively US Treasuries. And we know that, in terms of market stress, when people are concerned about a recession, they generally flight to safety. So we capitalize on the opportunity of buying high yield bonds. So where we get the benefit of a good spread component, which provides us with a margin of safety. And at the same time, if the market is under stress, we will find that we'll benefit from the flight to safety in US Treasuries. So so what we did in our portfolios, we captured this opportunity via ETFs, and we also introduced the Stone Harbor High Yield Fund into our portfolios.
And I mean, that's the first time we've actually bought into global fixed income because it's the first time that yields have been attractive.
That's correct. And Izak, if you recall, the last time we had a similar discussion, we actually identified that opportunity, and we paid very careful attention to the valuation opportunity because you want to have some level of safety in the type of instruments you buy.
If we come home to South Africa, I mean, against this backdrop of global yields rising, what did the local market do last year, and how has 2023 kicked off so far?
Yeah, so interesting. I think the US bond market basically sets the tone for global fixed income. So our short-dated and long-dated bond yields also rose in tandem with global bond yields. But what's interesting is that if you look at the beginning of 2022, South African bond yields were already high, and we know for structural reasons why you get such a significant premium in the South African bond market. So investors in South African bonds are actually getting a decent income by buying into those bonds. But because of the rise in bond yields globally as well as locally, we experienced a bit of capital loss. So the 12-month return to the end of December was about just over 4% for South African bonds. But with the strengthening of the rand and also with a bit of rally in bonds in the last quarter of last year, we see that to the end of January 2023, bonds are giving you about 6% for the last year. So in terms of South African bond market, certainly there's still a lot of value and opportunity that the market still presents for investors in bonds.
Michael, South African equity, how did that perform against the backdrop of global carnage on markets?
Yeah, so I mean, we weren't immune to global developments, but South African equities actually were a lot more defensive. And I think part of the reason for that is, I spoke about the lofty valuations that were there in global markets. In South Africa, we were actually reasonably cheap already. Our starting point was lower. That gives investors a margin of safety. So South African equities actually were positive against a backdrop of global negativity. Our market doing 4% for the 2022 year, largely driven by returns that we saw in our financials and our resources sector. Within financials, our banks did very well. Our banks specifically, and that's despite being exposed to all of the local economic headwinds. The banks in particular were coming off a very low COVID base, were releasing COVID provisions, but also as economic activity picked up, you saw increasing consumer activity, transaction activity, plus the endowment effect of higher interest rates. And that was all good news for the banks, and so they, as a sector, did quite well. Within resources, we are a commodity country. We have a much higher exposure to those types of companies than other global markets do. And particularly with higher commodity prices, and particularly those companies that are exposed to coal, they did very well against that backdrop. And I think similar to global markets, where the big outperformer from a sector perspective was the energy sector. Similar story in our market, although our energy sector is quite small. And then within industrials, it was a bit of a mixed bag. So the global rand hedges were generally negative, I think in line with what other global markets did. If we look at Naspers and Prosus in particular, two of the big companies in our market were negative in the early parts of the year quite sharply when the Chinese market and there was all the bad news there, but have risen very sharply as things have turned around. In fact, Naspers and Prosus both up over 100% from their lows that we saw in May last year. I think in terms of, probably worth pointing out as well, just how well our managers have done in this space and how it relates to our clients' portfolios and returns. So the combination of equity managers that we have in the South African equity space outperformed for the third consecutive calendar year. It was a good outcome in particular for M&G investments and in particular the retail boutique managers that we have in our retail portfolios, so 361, Battalier Capital and Laurium Capital. It was a good environment for those types of managers with sort of the hedge fund mindset and that sort of flexibility, which is I think also translated into good returns in our hedge fund, and that added a lot of value in our institutional strategies, and probably worth pointing out an award-nominated hedge fund as well. It's done very well for clients. And then lastly, maybe if we just look at 2023 so far, also off to a very good start. The CapSwix, our equity benchmark, up 7% in January, benefiting largely from the China reopening theme. A lot of the companies in our market exposed to that. And I think what that's done is you've had a good sort of short-term outcome, and that's made the longer-term numbers look a little bit better than people might expect. So over 7-10-year periods, South African equities have delivered 8 and 9% per annum respectively over those time periods. That's relative to inflation of around 5.5%. So you're getting a positive real return out of South African equities, not as much as it has delivered historically, but still a good positive outcome from that sense.
I just want to ask you about load shedding, because I think a lot of people are puzzled why the local market has done well against the backdrop of a worsening electricity crisis in South Africa.
Yeah, I mean that perplexes a lot of our investors, and that you would think, given all of the impacts that load shedding has, and particularly the outlook or the deteriorating outlook for economic growth and the knock-on effect has, that it would have had more of an impact. But I think the first point that I would make is to say that the economy is not the same as the equity market. And that's particularly true in the South African context, where we have a lot of offshore earners. In fact, the bulk of our market now, their fortunes in terms of where they generate their earnings is not tied to the South African market. So in January, for instance, as I mentioned, what drove our market was the China reopening theme, and you saw very strong returns from the likes of Naspers, Prosus, Richemont, all big companies in our market, nothing to do with load shedding, impacting those particular companies. And then I think if we look at those locally focused companies and the impact that load shedding has on those, we'd probably highlight as well that the impact is not linear. Different industries and sectors are affected in different ways. So a few examples, if you're in an energy-intensive industry, so your manufacturing, your chemicals, your mining, your smelting, those sorts of industries, obviously any loss in power is not good. And we've seen in particular, and I think that different stages of load shedding also impacts the companies differently. So we've seen one of the large platinum miners in our country effectively say publicly that at stage 6 load shedding, they aren't going to send people down mines because it becomes a safety issue, getting people out of deep level mining, and that has an impact on production. If we look at the retailers in our market, a lot of them have just reported sort of their festive trading season updates, and there was quite a contrast between those companies that have invested in backup power and those that haven't, in terms of the fortunes, in terms of their sales and their trading. But what we're also seeing is companies are starting to make massive outlays in terms of expenses on just keeping the lights on. So ShopRite is a case in point, probably the leading food retailer in our market, said that they spent 560 million rand on diesel in the last 6 months just to stay operational, and that's a mind-boggling number. And so you're having the impacts on those retailers where, you know, they're incurring, I guess, impacts on their trading and their ability to trade, but also higher operating costs. And that will have an impact, we think, on companies' bottom lines. And then for people like ourselves who work in financial services, so the banks, the insurers, in contrast to those more energy-intensive industries, relatively unaffected by load shedding. But I think maybe the final point that I would make as well, and where the impact is being felt severely, I think, is in the small and medium enterprise component of our market. Not all of those exist in the listed market, but the ones that are listed are your large operators. They generally have the revenues and the finances to be able to make backup plans. For the small and medium enterprises in our country, it's tough.
No, it certainly is tough. But I think there are 4 key takeaways from this discussion. The first is just the importance of valuation. As Michael said, you know, valuation doesn't protect you against a market sell-off, but it does give you a bit of defensiveness. So that is always very important. Linked to that, number 2 is that when there is a sell-off, when there is volatility, when there is uncertainty, that also creates the opportunities, as Ameer alluded to, and you need to be ready to act and invest and not be blinded by the uncertainty. I think the third point is just, again, the value of diversification, and you know, we always bring this up, but it is very important, and you saw it last year with local returns actually being positive against the backdrop of global returns being sharply negative. Now, that's not always going to be the case, and you know, you cannot forecast which is going to do better one year to the next. But again, the point is to spread your assets around so that you are not beholden to one single particular outcome. And then I think the last thing is just, it's amazing how quickly markets can turn around. And that's what we've seen in the last couple of weeks. And I don't think anyone could have predicted it. I certainly don't think anyone could time it. You just have to be invested to benefit from these turning points. And that's why we have the old saying, you know, it's all about time in the markets and not trying to time the markets themselves. So I hope you found that useful and interesting. Thank you, Michael and Ameer, and thank you for joining us.